On today's episode, we'll be looking at accounting equation as a topic. So, without much ado, let's dive into the topic for today. So, accounting equation, accounting equation. So, accounting equation is a mathematical expression that shows the asset of the business and the claim against the asset of the business. So the claim against the asset of the business are usually the capital as well as the liability. Now, in one word, what accounting equation simply explains is that how is the resources of the business financed in terms of ownership? How is the business resources being owned? Is it only being owned by the outsiders, or is only owned by the owners, or is owned by the owners as well as the outsiders? So this is basically what that means. So what accounting equation is saying is that the asset of the business is owned by who? Is it just by the owner, which is capital, or by the owner as well as the outsiders? That's liability. So, simply put, accounting equation is saying the asset of the business, which is the same thing as resources. And when we say asset, asset simply means those resources a business owns and use for its operation in order to generate revenue. So anything assets must also provide future benefits for the business. So these assets now, let's say for example, examples now of assets. We have plants and machinery, we have land and building, we have motor vehicle, we have furniture and fittings, and so on and so forth. So all these assets, who owns them? How is these assets? How are they being financed? Are they being financed by capital, which represents the owners of the business? So another word for capital is the owner's interest or owner's contribution into the business. Or most times we usually call it owner's equity. Or is financed by the owner as well as liability. We call this the outsiders. Those are the individuals or business organizations that the business is owing. So these assets, the money provided by the owner of the business, which is capital, as well as the money which the owner of the business borrowed from outsiders. Now, if the asset of the business is financed or is funded by the money that is provided by the owner of the business, you will have the accounting equation to be expressed thus. That means you will have assets, that's the resources of the business, to be equal to capital. So this equation is applicable where the owner of the business owns all the resources or the asset of the business. So this is a situation of small scale businesses, that's one man business, sole proprietorship. However, if the asset of the business is acquired by the fund that is provided by the owner, as well as the money borrowed from outsiders, which could come in form of creditors, shareholders, bond holders, debenture holders, and all that. Those are examples or components of which liabilities could come. So in that case, you will have the assets to be equal to capital plus liability. And what that means is that the asset is owned by the owner as well as the liability, which are the outsiders. That's what we mean. So in that case, I wanted to express it here, which I already expressed it. So where the assets is uh, acquired or purchased by the money that is provided by the owner as well as the outsiders, then you have the accounting equation to be this. And this is applicable to large scale businesses. That means limited companies as well as public limited liability company, that's PLC. You will have this to be the accounting equation for such companies. But for small scale businesses, sole proprietorship, uh, you will have this to be the accounting equation for such. So one thing also you have to know with respect to accounting equation is that capital is usually a component of these assets. That means the owner of the business owns a portion of these assets. And also those outsiders, those creditors, they also own part of these assets. So this added to this gives you this. But most times you could have capital to be equal to assets. And when you have this, don't forget in your maths, when you have A equals B, then you also have B equals A. That's what you have. So if you want to determine your capital now, your capital you have, the capital equals assets minus liability. So here now you want to determine the owner's contribution into the business. So let's say, for example, let's say asset is 50 here and capital is, let's say, 30. Then liability will be 30 plus what we give you 50. That should be 20. That's 20. So here now you want to determine how much the owner contributes into the business that he or she owns. So here we have capital to be 30. Then here you're going to have assets to be 50 based on this example. Then you have liability to be 20. But in this regard here, or in this example here, you will have assets to be, let's say, 50. Then capital is also 50. This is what you have. So also if you want to determine liability, liability, don't forget, is just a component of assets, which we have talked about earlier. So it will be assets minus capital. That's what you have. So you want to determine the portion of the asset of the business, of the resources of the business that is owned by the outsiders, which are basically creditors, the venture holders, and all that. So here, the asset is 50, like we talked about, it's 50. Then you have capital. Capital is 30, 30. Then you have the liability. That means 50 minus 30. That gives you 20. So 50 minus 20 gives you 30. So to determine your assets, you have capital plus liability. But in most cases, it could be just capital. And to determine your capital, you have your assets minus liability. And for you to determine your liability, that's assets minus capital. So let's solve some questions regarding this accounting equation we've talked about. So let's solve one or two questions to be able to stress out this further. So, so let's begin. So question one now. Given, given liability as 40,000 and capital to be, let's say, 60,000. So here now you have to determine assets. Determine assets. So to determine assets, you already know from what we stressed so far that assets solution now. Solution. That means to solve this now. So assets, write out the formula. Asset equals capital. Capital plus liability. So you've been given liability to be 40,000 and capital to be 60,000. So here you have 60,000 plus 40,000. So 60 plus 40, that gives us 100,000. So our asset is 100,000. So your asset is capital plus liability. So that's illustration one. So let's solve for that question. So illustration 2 now. Given assets, given asset as 200,000. Then you have capital as, let's say, 150,000. Then you have to determine liability. So to determine liability now, you already know solution now. So let's solve solution. So liability equals assets minus capital. So we have been given asset as 200,000. So we have 200,000 minus, we have been given capital as 150. 150. So 200,000 minus 150, that gives us 50,000. So our liability equals 50,000. So that's what we have. So to determine your liability, it's assets minus capital. That's what we have. Then let's take further question. Let's take further question. So illustration 3 now. Given assets as 150,000, then you are given capital. Okay, let's say you are given liability as let's say 50,000. Then we have to determine capital. So to determine capital, we already knew. So solution. So to determine capital is expressed as assets minus liability. That's what we have. To determine capital, that's assets minus liability. So assets in this regard is given as 150,000. So 150,000 minus liability is 50,000. Then 150,000 minus 50,000, that gives us 100,000. So these are capital as our capital. So I hope this is understood. So let's solve one or two questions more. Because there are times tricky questions, maybe examine in most exams. So let's solve one or two tricky questions regarding this accounting equation. So let's say illustration 4 now. Illustration 4, given owner's equity as 70,000. Then you have owings to outsiders. As 20,000. Then here you have to determine assets. So you have to determine assets. So in this regard, let's solve. So solution now. Solution. So to get your assets, you already know assets, going by the accounting equation, asset equals capital plus liability. Asset equals capital plus liability. Now in this question, some students may be confused because you are not given capital straight away. So anytime you are given owner's equity, it's the same as capital. So owner's equity means owner's contribution into the business, or most times they call it owner's interest in the business. That means the portion of the owner that is contributed into the business. So owner's equity is the same thing as capital. Then the same with owing to outsiders. Owing to outsiders simply means liability. So it's a component of current liability. So each time we are given owing to outsiders, it means liability. So it's self-explanatory here. So assets, capital now is 70,000 plus, then owing to outsider is 20,000. So here now we have 70 plus 20, that gives us 90,000. So 90,000 is our assets. So that's what we have. So I hope this is understood. Then let's solve the last question, after which we move on to, or we take it further. We go it further on accounting equation. So the last question now. The last question is, okay, that's question 5. Given assets as, let's say, 50,000. Then here you are now asked to determine capital. Look at this question, very tricky. It's small but mighty. So to solve this question, solution, we have to determine capital. And you all know capital is expressed as assets minus liability. This is what you have. To determine your capital, you have assets minus liabilities. And don't forget, we did say earlier on that most times capital may be equal to assets and assets may be equal to capital. And what that simply means is that the owner owns all the resources, all the asset of the business. That's what it means. It simply means the owner did not borrow money from anybody to start the business and all that. That means no liability. That's what it means. So exactly what we have in this question, no liability was given. So what we have basically is asset is given as 50,000 and liability, since nothing is given regarding liability, so you assume it to be 0. So that's 0. Then the capital now, that's 50,000 plus 0, that gives us 50,000. So that's our capital. So this is what we have. So this is our capital. So here now, capital is equal to assets. And when our capital is equal to assets, asset is also equal to capital. So this is for small scale businesses that doesn't require huge capital to start. So the owner can just start the business with his own fund or money. And that means the owner did not borrow any money from anybody, no creditors, no liability. That's what it means. So uh, that's the questions on accounting equation. So one thing you have to bear in mind uh, now is that accounting equation gives birth to the preparation of statements of financial position, which is balance sheets. We've stressed that in our previous episode. So we want to prove that now, how accounting equation gives birth to the preparation of statement of financial position. And after we've proven that, we are going to draw, using that equation, the statement of financial position, which is the same as a balance sheet of a business organization. So come with me. Let's do that together. So accounting equation, like we've emphasized, we said it is equal to assets. Asset equals capital plus liability. This is the accounting equation that we have. So let's shorten these words here. Let's shorten them. So if you agree with me, A equals C plus L, which is for liability. C is for capital, L is for liability. So assets now. Asset has lots of classifications, but for the purpose of drawing the statement of financial position, we are going to classify it into two. and that's non-current assets and current assets. That's what we are going to classify these assets into. Then for liability, it's classified into two basically. We have non-current liability, which is the same thing as long-term liability, and short-term liability, which is the same thing as current liability. Then, so let's go now. So assets now is classified into non-current assets plus current assets. That's for assets. We have classifications of assets. We have non-current assets, we have current assets, we have tangible, intangible, fictitious assets, liquid assets, and so on and so forth, wasting assets and all that. But for the purpose of the balance sheet we want to draw today regarding accounting equation, we are limiting it to two, which is non-current assets and current assets. So equals capital. This capital represents the owner's interest in the business or the owner's contribution, and it means what the owner contributes into the business. That's capital. Now, most times, what the owner has contributed into the business, the owner might also withdraw part of it for his own personal use. That means the owner takes out of the business for his own personal use or consumption. We call that drawings. So where would the owner takes the goods or cash for his own personal use? From the capital. So that means you will have to minus what the owner takes out of the business, which is called drawings from the capital. So it will reduce the capital. That's why we have drawings here. Also, from this capital, the primary purpose of the owner introducing the capital or funding the business more, which is also capital, is to generate revenue. And when we say revenue, we also mean profits. And it's either the business generates profit or loss. So when the business generates profit as a result of the introduction of the capital into the business, then we add the profits to the capital. We add the profits to the capital. But if it is loss, we minus it. That will be loss. We minus it. But we are assuming profits. So that's why we have P here. Profits. We add that profit to the capital. Then liability now. We have plus. Don't forget, we did say liability is classified into non-current liability and current liability. So we have non-current liability plus current liability. So this is what we have. So let's go. What we want to do in the next step now is collection of lifetimes. So non-current assets now plus current assets. Then we bring this current liability to this side. From plus now, plus it will change to minus. So we have minus current liability. So we put it in brackets. Then this non-current liability, now we bring it to this side. It will also change from plus to minus. So we have minus non-current liability. Then equals, that's, we have capital minus drawings plus profits. That's what we have. So we're almost getting there. So we have non-current assets plus current assets minus current liability will give us working capital. So working capital is gotten by minusing your current liability from your current assets. So minus non-current liability. Then you have equals capital minus drawings plus profits. So this is the accounting equation which gives birth to the preparation of statements of financial position, which is the same thing as balance sheets. So this is what we are going to be using to draw the statement of financial position of the business. So let's do that together now. So what you're going to do now is put this somewhere so that by the time we finish drawing the statement of financial position, you will have to kind of compare if the two align. So let's do that now. So let's draw the format of the statement of financial position or balance sheets. So let's do that together. Let's do that together. So, so we have statement of financial position to prepare. Sorry, I think I have a marker here. Okay, so statement of financial position. So the name of the business is XYZ Limited. Then we have statements of financial position for the year ended for the year ended 31st December 2022. So this is what we have. So let's begin. So we have costs, then we have accumulated depreciation. Accumulated depreciation is the same as the total depreciation on the assets. From the day you acquire the asset till the day you dispose it, all the depreciation you calculated on that asset is called accumulated depreciation. Then we have the net book value. Net book value is the net present value of the asset, the net worth of the asset. What the asset is worth now is the net book value. Sorry, net book value. So we have the naira sign here. So let's start with the non-current assets now. So non-current assets. So examples of non-current assets. Non-current assets are those durable assets that have a lifespan of more than 1 year. And the amount that is usually spent on them is called costs or expenditure. We call it most times capital expenditure. And the cost of that non-current asset is usually spread over the estimated useful life of the assets. We're going to talk about some of those terminologies for your better understanding. But today we just want to draw the format, and in our subsequent episode, we'll do justice to some of those terms that are kind of confusing to you guys. So just stay tuned, all right? And that's why you need to subscribe to our YouTube channel and ring the notification bell so that each time we produce a video, you will be the first to get uh, notified on that. Thank you all in advance. So we have non-current asset now. We have land and building. So land and building is an example of non-current assets. So in the question, you'll be given the cost of the assets, then you have the depreciation, then this minus this will give you the net book value. Then we could have plants and machinery, plant and machinery. This is the cost. Then you have the depreciation. This minus this will give you this. Then you have office equipment, office equipment. Then the costs, the depreciation, that's the accumulated depreciation. Then you have the net book value. You could have uh, delivery van. Delivery van is an example of non-current assets. So you have the accumulated depreciation and you have the net book value. You could have furniture, furniture and fitting, furniture and fitting. So you have the costs, the accumulated depreciation, and you have the net book value. So let's assume these are the non-current assets that we have. We still have other one. We have motor vehicle premises, field premises, and all that. So the cost, you are going to total everything and close it. You add all this, you add it. Then you close it by drawing two lines. Then the accumulated depreciation as well, you are going to add everything and close it. Then your net book value, you are going to add everything, but you're not going to close this because you're still going to be adding to it the working capital. So that's with respect to non-current assets. So we have current assets now. So current assets. Current assets are those assets that have a lifespan of just 1 year, and they can be replaced within the accounting period, which is usually 12 months. So current assets must be arranged in the balance sheet, that statement of financial position, according to their liquidity, in terms of how they can be easily converted to cash. That's the way you should arrange them. So first and foremost, we have our stock. That's another word for inventory. That's a closing stock, basically. Then you have the amount here. You have debtors. Debtors. So you have the amounts here most times. Then you less from this your debtor anything provision, maybe provision for bad debts, provision for bad and doubtful debts. You less it from your debtors. So you less it. When you less it, you have this. When you less your provision from your debtors, you have what is called good debtor balance. And that good debtor balance is the debtor balance that its collection is certain. I mean, it is certain that you are going to collect the amount. That's good debtor balance. Then you could have bills receivable. Bills receivable is also a component of current assets. Then you have income in arrears. Income in arrears. You have is also a component of current assets. Then you have, let me continue from here. Okay. We have cash and bank balance. Cash and bank balance. Most times we have cash in hand, cash at bank. It's put together here as cash and bank balance. Then let me continue from here. So we have the first, the second, and the last column. Then we have expenses. We are still on components of current assets. So we have expenses, expenses prepaid or expenses in advance. Any form of expenses that is prepaid, that means the business is paying for that expenses for the next accounting period. So it is considered a component of current assets. So you have paid for a particular service, but you have not enjoyed that service. It is prepayment. So be it electricity prepaid, insurance prepaid, rent prepaid, wages or salary prepaid, and all that. It's a component of current assets. Then you could also have short-term investments. Short-term investments. Short-term investments. So we have expenses prepaid here. We have short-term investments. So let's assume these are some of the current assets we have. So we had from here. Then we also have this. So we had everything. So this is what we have. Let's tag a figure to some of them. Let's say the total net book value of all this is 100. Just for you to have a nodding acquaintance of how we are going to be preparing it in our subsequent episode. So here is an assumption 100. So we go to current liabilities now. So liabilities, current liabilities. Current liabilities also mean short-term liabilities. They are those indebtedness or owings of a business organization that will be settled within a period of 12 months or accounting period. That's 12 months. So current liability must be arranged in the statement of financial position according to their preference. That means how important they are. That's how you arrange it. So you don't just put those items any how you like. So you start with creditors. So we have creditors. Creditors. So we have this. Then we could have bills payable. Bills payable is a component of current liability. Then we could have income. Income in advance. Income you have not worked for. but you have received it. It's called income in advance. So it's a liability. So the component of current liability. Then we could have bank overdraft. Bank overdraft. Then we could have expenses. Expenses owing, or expenses due, or expenses accrued. Accrued, accrued, or expenses outstanding, or expenses in arrears. All these are the same. Owings, due, accrued, outstanding, unpaid, arrears. All of them are the same. It means you have enjoyed the benefits, but you have not paid for that expenses. So it's a liability, it's a component of current liability. So then let's assume these are some of the liabilities that we have. So we had everything, then we put it here. The total of this, we put it here. Then we minus it from the current assets. So let's say current assets. Okay. So what we have is working capital. Working capital. So current assets minus current liability gives us working capital. So that working capital will be here. So your working capital added to your total non-current assets. This is the total non-current assets, the net book value. So we add it to this. They're on the same line here. So we had it. So let's assume this is 50. So 50 plus 100, that gives us 150. That's what we have. Then we have, this is this is total assets. This is total asset. That's working capital plus total non-current assets. Then we less our long-term liability, long-term liability, or we can call it non-current liability, non-current liability, non-current liability. So let's say examples of non-current liability, we could have bank loan, or we can have the venture, the venture. So let's say the venture that we have is, let's say is 50, 50. So since we are lessening it from this, so 150 minus 50, that gives us 100. So these are net assets. So these are net assets. That's what we have. Then we have financed by. Financed by. How are these assets? The total asset. How are they financed? So financed by them, we have capital. Capital. So let's say capital is this. Let's say capital is 200. Then we had our net profit. If it is profit, you add it to capital. If it is loss, you minus it from the capital. So add net profit, net profit. So let's say net profit is 50. So we add it. Then we less drawings. Drawings. So drawings, this plus this has 250. Then drawings, let's say our drawings is 150. So 250 minus 150, that gives you 100. So this is how the business is financed. So these two figures must be the same for you to be sure that your balance sheet is, that's your statement of financial position, the workings, the postings, the recordings are intact. That means your total assets must be equal to your finance by. That means it must be equal. So 100, 100. So that means they are equal now. So this is where we are going to draw the curtain for today. So using the accounting equation to prepare a balance sheet. Like I said, accounting equation is gives birth to the preparation of financial statement of financial position, which is balance sheets, and that's what we have prepared on the board. So this is where we are going to be drawing the curtain for today. Thank you for the time so far. I wish you a brilliant and excellent journey in your academics. Subscribe to our YouTube channel, like our videos, and share these videos to some other students, friends, neighbors, families, whom this video might be of great help. So I say bye for me. I'll see you on my next video. Bye bye.